In this video, guys, we're going to look at what is spread betting and how does it differ from CFDs. Stay tuned. Hey traders, warm welcome to you. Alright, so decision that many traders make, especially if they're kind of new to the game and you're kind of interested in expressing an interest in the direction of a particular asset, up or down, or you just kind of get into trading and think, hey, what's it all about? And you hear, what's CFD, spread betting? Now, which one do I choose? I kind of get what they do roughly, but how do I choose one? Hopefully this video will give you an idea of what they're all about, some brief overview, why you pick one over the other, some of the subtle nuances. Ultimately, guys, they're almost the same vehicle, you're almost getting the same exposure. But there are some little subtle differences that maybe will influence your decision as to which one you want to choose. All right, this is no recommendation to trade. You know, trading is super risky regardless of one of these things, whichever one of these vehicles you decide to choose. But if you do decide to trade and you've taken all the advice, you've done all the stuff, you understand the risk involved in it, then picking the right one is worth spending a little bit of time on, just so that you can do it, forget it, and then you can focus on making good trades, your setups, your strategies, and focusing on making, you know, the right plays in the right time. So this video is sponsored, by the way, by the description below, and those guys do offer CFD and spread bet. Relatively new offer for them from the spread bet for the UK and the Irish clients, so worth looking at if you're in the market for a broker that's regulated in the UK, FCA regulated. Let's have a look at CFDs and spread bets. So ultimately, you know, whatever you're doing, whatever vehicle you're using, it's very simply this, guys. If you decide that the market is going higher, you believe the market is going higher, you would buy or go long, that's what it's called. So with a CFD, you're basically buying a contract, and this instantaneously happens. No one sits there and writes out a big contract. It's a contract for difference, and that basically says, okay, do you know what? If the market goes higher, and I sell this asset for a higher price than I bought it for on the platform, the broker will pay me the difference. If it goes lower and I bought it and I have to sell it for a loss, I will pay the difference from my trading accounts. If market goes up and I make £500, for example, that will be credited to my account. If the market goes down and I lose £200, that comes out of my account, for example. So that's what happens when you're trading a CFD. You're trading a contract at a time. You get no ownership of the underlying asset. You're just trading a contract for the difference in price. Now, spread bet, slightly easier to understand, just about. It's not a complicated instrument, CFD guys, but maybe slightly simpler a spread bet. You're trading in pounds per point. So you stake, let's say £10 a point, the market goes up 10 points, you're going to make £100, 10 points times your £10 stake. If it was £1 a point, you make £10. If it goes up 100 points, you make £1,000. You get the idea at £10 a point. You get the idea. If it goes lower, however, you're going to lose that. That's going to be taken from your account. So it's very simple to understand. And one of the benefits of a spread bet, guys, is you hold your funds in GBP, and very easily you can trade crude oil, you can trade Dow, you can trade FTSE, you can trade any of them offer, and you're going to win and lose in British pounds. So very simple, very easy. You know, if crude oil goes up 100 points, you made 100 points. If Dow Jones goes up 100 points, you made 100 points. It's kind of a standardized trade or bet, if you like. You know, it's simple to understand, and you can just as easily speculate on the price of gold as you can crude oil, as you can FTSE, as you can NASDAQ, as you can all these other instruments, as you can euro, US dollar, same kind of stuff. So you get that the richness of all the markets that you can trade, but with the simplicity of understanding how your profit and loss is calculated. Now, there's some things to point out that if you're trading, if you've got a really, really long-term horizon, you probably haven't, because that's probably not why you're here. But if you've got years and years horizon, these vehicles aren't really suited for the very, 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 very long-term investor. They're more for active traders. They're more for swing traders if you're holding over a couple of days, a couple of weeks, maybe a couple of months. Day traders, again, super popular with day traders if you're looking for that little hour move or a little 5-minute move or a scalping around. You know, these are the kind of products that work well, purely because you're not paying any stamp duty. So if you were trading actual underlying shares in the UK market, you have to pay stamp duty, which obviously if you're an active trader adds up over time. So you don't pay stamp duty. That's because you're not actually taking ownership of the product, the underlying asset. You're just betting on the direction, regardless of which of these vehicles you're using. You've got the costs that are generally wrapped up in the spread with spread betting, and CFD, depending on the instrument you're trading, can be a commission added on, or it can be wrapped up. But go and check them out. If you want to check their information there, you know, all the markets are there. Find out which markets you trade, see what the spreads are like, see what the costs are like, and do your own research and that way, guys. So big range of markets. You can trade pretty much anything for the CFD, pretty much anything as well with the spread, but all the major currency pairs, loads and loads of different currency pairs, indices, commodities, you name it, a big sea of markets. The other thing, guys, which is the most important differentiator, so far they're all very reasonably similar, apart from sort of some nuances of how the profits are displayed and kind of the GBP thing. But the big reason why people will choose a spread bet over a CFD is the fact there's no capital gains tax to pay. Now, that is as it stands right at this moment. And again, I'm not an accountant. You need to go and do your own due diligence on this. I can't here and advise you guys, but that's pretty much the way it is. If you're trading a CFD, it's treated as and you make a gain on it, it's treated as a capital gain. You've got to do all the forms that go with that. A spread bet is just treated as a bet, winnings from a gamble, which currently don't attract any capital gains tax. So that is why it's so attractive, especially for UK clients, and that's what it is in the UK. In other countries, you don't have access to spread bet, but talking from a UK perspective, that's why it's so attractive. It's literally taking a bet on the direction of an underlying market. FTSE goes up, you're long, you make 3 grand, that 3 grand goes straight in your pocket. The tax man doesn't take any of that from a capital gains perspective anyway. And there's some very unique circumstances, but if you're a unique circumstance, you'll probably be aware of that and your accountant can advise you on that. However, broadly speaking, that's the way it is. Now, the other thing, one thing to point out, guys, is you might choose a CFD if you're using it to hedge against a portfolio, because in actual fact, you might not want the fact that it's treated as a bet. Most people will. If you're just a speculator, like myself, for example, and you say, okay, I'm looking to speculate on the direction of gold or the direction of silver or the direction of this or that, then the idea of paying no capital gains is probably quite appealing to you. Now, if you are hedging a portfolio, you might not want it to be in a tax-free wrapper like a spread bet, because you want to treat it as a pure hedge. So if you've got £100,000 worth of exposure, let's say with a portfolio, and you happen to have those products available as well to you, and you can trade them on CFD and you short, so your net exposure is 0 because you think maybe the next few months are going to go lower, you probably want it to be taxed via a CFD so you can offset any gain that you'd perhaps made with the other instrument. Because if the other instrument you're going to make tax on that, you want to offset the loss on it, you want to be treated like a taxable instrument, whereas a spread bet, you can't do that. So that's a very unique case. I think for most of us watching this, we're speculators looking just to purely speculate on the direction of an underlying asset, in which case, for many of us, a spread bet is the most attractive vehicle to use to do that for short-term trading, for day trading, for spread bet and CFD, guys. If you want to go and check them out, there's a link in the description below. Have a little through the website and see if they're right for you. Hope that's helped. Take care. See you next one. Bye-bye.